FountainFX on Thursday the 24th of July 2014. We are looking at the gold against the US dollar, and it's very nicely just broken while we've actually started the recording. Look at the momentum in which it's gone down. I've just gone $1,400 up in my trade. Anyway, so we are looking at that, and what I'm wanting to share with you is the way of using stop orders in which to enter trades rather than just using them to exit trades. And particularly use them to protect your risk and exit trades when the price goes against you in terms of the direction in which you're trading. But you can also use it as a great way to trigger an entry when price goes against its direction but for you in terms of the trade. So a good example here is right in the middle of the screen. We've got an uptrend that was pushing up, but you can see it was starting to get exhausted. So what you could have said is, look, if you see here, there's now an area of support here. It's pushed up, it's pulled back down. What about the possibility that it breaks below this area? I know if we go back to the left, it was a previous area of resistance. Okay, so therefore it may be a case that what I want to do is, what if it doesn't actually hold as an area in which to buy? Okay, because what's actually happened here is it was a previous area of resistance. If we look, it's broken through, it pulls back. So the natural thing is to look to buy at this area, because why should we buy at that area? Because that's the normal common law, which is resistance has now become support, and what do? You buy at support. And if we buy here, we're not doing the wrong thing because we're actually going with the trend. Okay, we're going with the fact that it's now support, what was resistance. And it's also, price has pulled all the way back to this very nice trend line here. So it's a good, from that viewpoint, it's a good trade entry based on our rules. However, price doesn't actually perform that way, as we can see, and it pushes up, pulls back down. So you have a stop below that area in order to protect yourself should price come back down, and therefore take it out so that you minimize your risk. But what you can do, so if you're looking at this and you're thinking, hang on a minute, that was a pullback there, so it did pull back to the area, it pushed up, but when it pushed up, it didn't push up all the way back up to the previous high. So it looks like the move is exhausting. It pulled back down, so alright, it's pulled back down to the trend line, so now I've bought. But you need to be aware of what's happening now. It pushes back up, turns, and then creates this bearish candlestick right after this bullish candlestick, and still doesn't take out this previous high here. So guess what? That upwards move is starting to exhaust. It's showing that. So therefore, well, it may not pull back down, but if it does pull back down, I want to get involved on this trade. So what I do is, where this line is, or probably just a bit below it, if I drag it down, give it some space to at least do something right. So let's say I can place a sell stop order here below this area, and I can say, look, when it does break with the sell stop order, that will trigger me in. My sell order will be here. So I can place a sell order that's below where current market price is, because I want to pick up the momentum should price go reverse and go in the opposite direction. And that's really the trade order there, so the method of trading. For example, the other way to do it is to do a buy stop order if you think price is no longer going to fall and it could potentially whip back upwards. So therefore you want to catch it as price pushes up. Normally you would use this kind of order with multiple time frame analysis, so you'd be able to see that the big picture is saying there's an uptrend. The smaller picture is saying that there's actually a pullback or a short downtrend, and therefore with the break of this downtrend you would then want to have a buy stop to trigger you into the trade and take profit as it moves. And that's really it from FountainFX. Hopefully that makes sense, but we can cover it and go over it as time goes on. That's the reason for having the daily blogs and the constant analysis of the market, because you don't learn anything in an instant. It takes 3 years to get your degree, or 4 years in some instances, and you know, so don't expect yourself to suddenly become a professional trader because you've learnt one tip or one technique, but it's something that you can apply very easily time and time again, and you'll be able to see where you can take profit from using these techniques. That's it from FountainFX. We'll go through another trade strategy tomorrow in terms of order entries and exits, and happy trading from FountainFX. Goodbye.